Last time we spoke, we established that the market's foundation didn't just crack, it broke. The story of a strong economy, we now know, was just that, a story. And now, seeing your portfolio bleed a bit, the big question is no longer if there's a problem, but how far do we fall? Oh, but please just bear with me and don't immediately think of me as an ultimate bearish cat, because the most costly mistake you can make in this environment is to react without a map. To either sell in a panic or buy what you think is a discount. The real solution is to recognize that the market is following a familiar playbook, one we've seen unfold in the summers of the last 2 years. Look, if you're short on time, here is the single most important takeaway. The summer weakness is here, but the key indicators that signal a true market bottom are not even close to being triggered. This suggests the period of maximum pain, and therefore, the period of maximum opportunity is likely still ahead of us. Hey everyone, DataCat here. For those of you who are new, I used to be an analyst inside a Fortune 50 company, but I traded the corporate grind for this. A quiet room with lasers and keyboards. I'm an introvert, and when I was back in the office, I literally only spoke with others through Slack. So putting myself out here is still a bit new, but I believe this kind of data-driven analysis is crucial, especially now. My channel is just about a month old, and I just have to say thank you. The support has been genuinely incredible. We are trying to get to 50 subscribers, which feels like a huge milestone. So, if you get any value at all from this video, I would be so grateful if you'd hit that subscribe button. It really does help. Alright, let's build on what we know. In our last discussion, we identified the catastrophic July jobs report as the event that shattered the strong economy narrative, and you've hit on the absolute core of why this jobs report was different. Let's tackle that idea of revisions, because it's a fair question for anyone who follows this data closely. But comparing the routine, minor tweaks of a few thousand jobs to the retroactive vaporization of 250,000 jobs is like comparing a leaky faucet to a burst dam. In fact, Goldman Sachs has noted the revisions were the largest outside recessionary times since 1968. And to clarify again, for months, the market has been engaged in a delicate and frankly greedy balancing act. The narrative that kept the rally alive depended on one thing, the headline jobs number. It was the market's hopium. As long as that single number looked solid, institutional money could tell itself a story. They could ignore the contracting manufacturing sector, the rising delinquencies, and most importantly, the general feeling of unease that many people have been experiencing for over a year. It was a willful suspension of disbelief. The magnitude of this revision, a combined minus 258,000 for May and June, didn't just say July was weak. It was a retroactive confession that the story the market was telling itself for the last 2 months was a fantasy. This is why it changes everything. The pretense is now impossible to maintain. The revision was the loud, shattering crash that forced it to confront the reality that the mantelpiece was never stable to begin with. For those of us feeling the economic pain long before this report, it's a moment of validation. The market's reality, fueled by greed, has finally been forced to align with the public's reality, which is grounded in experience. The hopium has run out. Well, at least for now. Yeah, also a side note for those who haven't noticed, the market is basically a junkie. Hopium will resume at one point, but we will discuss it later. Now, where were we? And just as that reality set in, the new data we just received from the manufacturing sector doesn't just support this view, it cements it. The cracks we were watching have now become deep, undeniable fissures. I'm talking about the ISM manufacturing PMI. A reading below 50 means the sector is shrinking. The July number came in at 48.0, its 5th consecutive month of contraction. In fact, the US manufacturing sector has now been shrinking for 31 of the last 33 months. This isn't a temporary dip, it's a chronic illness. And if you look inside that report, the details are even more grim. The new orders index, which tells us about future demand, saw its 6th straight monthly contraction. Companies are not getting new business, which will inevitably hit their revenue and earnings down the line. But here is the most critical link, the data point that confirms our fears from the last video. The ISM employment index collapsed to 43.4, its lowest level since the 2020 lockdowns. A stunning 25% of US manufacturers cut payrolls in July. This directly proves that the disastrous jobs report wasn't a statistical fluke. It's the real-world consequence of a manufacturing sector in a prolonged recession. The market cat wasn't just startled by one loud noise. It's now seeing the entire mantelpiece it's standing on is riddled with deep structural cracks. Now, I know this all feels chaotic, and now you might be calling me a bearish cat again, but the market's behavior is actually rhyming with recent history. Understanding these patterns is the key to navigating the coming months without succumbing to panic. Before we look at the years, let's quickly define our tools. 3 very simple metrics. We're watching the 50-day moving average, a key trend line, the VIX, which is the market's fear gauge, and the RSI, which measures market sentiment. Let's look at the 2023 precedent. The market peaked in late July, and then in August it broke decisively below its 50-day moving average, entering a prolonged correction. The ultimate bottom, the point of maximum pain, didn't arrive until late October. During that period, the VIX spiked above 20 and remained elevated, hitting a peak near 30 right around that market bottom. Then we have the 2024 precedent. A slightly different pattern unfolded. The break below the 50-day moving average in early August was much sharper. The recovery was faster than in 2023, but it was marked by extreme volatility. The VIX showed a much more violent spike, briefly touching 60 before settling down and retesting the 30 level multiple times. But again, the bottom coincided with that key RSI indicator approaching the 30 level. So that brings us to today. Where are we in the 2025 playbook? First, the dip. We have not yet decisively broken the 50-day moving average. This tells us the technical falling pattern hasn't even truly initiated yet, despite the sudden drop on Friday. Second, volatility. The VIX has just crossed the psychologically important 20 level. Compare that to the peaks near 30 in 2023 and that brief, violent touch of 60 in 2024. A VIX at 20 suggests we are in the early stages of volatility expansion, not the final capitulation. Third, sentiment. The fear and greed index is now sitting at a neutral, down from greed at 71 just a week ago. We are at a pivot point, not yet in the fear or extreme fear territory that signals a bottom. And the RSI confirms this. The current RSI is around 47. This is trending down, but it's still a world away from the 30 level that marked the bottoms in both 2023 and 2024. History suggests that while the summer weakness narrative is playing out fueled by some not-so-surprising black swan event, we are likely not near the point of maximum pain, or more importantly, maximum opportunity. The cat is scared and has puffed up its fur. That's the VIX at 20. But it hasn't started frantically clawing at the furniture in a full-blown panic yet. And so, this week is poised to be pivotal. The market will face a series of tests that will either confirm this bearish narrative or provide a glimmer of hope. On Monday and Tuesday, we get the other half of the economy story with the services PMI reports. We know manufacturing is in a recession. The bullish argument has been that the much larger services side of the economy could hold everything together. If these reports show significant weakness, it will signal that the rot is spreading, leaving no pillar of the economy unscathed. Then, throughout the week, the AI pillar faces a stress test. With earnings from AMD, Palantir, and the Titan Nvidia, the question is no longer about their past growth. The question is, can their forward guidance withstand these macro headwinds? Any sign of lowered guidance will be a direct hit to the market's last remaining pillar of hope. And finally, we have 5 different Fed speakers scheduled. They are now forced to address the market's new reality. Will they acknowledge the labor market's collapse, or will they try to talk tough on inflation, further spooking the market? Their words will be dissected for any change in tone. The evidence points to a decisive and negative shift in the market environment. The base case is that the market is repricing for a period of significant economic weakness, consistent with the patterns of the last 2 years. A true market bottom is unlikely until we see signs of capitulation. This would likely involve the VIX pushing towards 30 or higher, the S&P 500 RSI dipping to 30 or below, and a clear kitchen sink moment where companies issue dire forward guidance. Again, this is a time for defense and patience. The wall of worry we discussed has crumbled into a chasm of fear. That $7 trillion in cash on the sidelines is now behaving as emergency supplies, not as fuel for a rally. The smart cat doesn't try to catch a falling knife, it waits, watches the storm from a safe distance, and prepares a plan to pounce on the generational opportunities that are always born from maximum fear. That's the analysis for today. If this data-driven approach helps you make sense of these chaotic markets, I'd appreciate it if you'd subscribe and hit the notification bell. I'll be tracking these developments closely. Thanks for watching. DataCat out. Stay sharp out there.